Hey there, today on the final bar, we'll do our normal Monday routine where we hit the market from three directions: top-down macro, bottom-up stock picking, sector rotation. We'll hit on the key charts in each of those areas. The S&P really in a choppy environment today, sort of, trading all around that equilibrium level, just above 4,200. We sort of settled down on there for the close. So overall, sort of mixed messages, flat, but energy, the real story, pushing to the upside along with real estate. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. Hope you had a great long weekend. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on these markets through the lens of technical analysis, focusing on the message the markets provide by focusing on price action. John Murphy, in one of the first book I read on technical analysis, and one that I reread a number of times as I was learning the discipline, reminds us that price reflects all known information, right? Price reflects the collective psychology of all the investors. So if you have one thing in your arsenal to try to make sense of the markets, I would argue you're best using price itself. So what message do we really get from today? Well, we're going to hit it from three directions, starting with the macro picture. I don't know if this today answered a lot of questions because it was really a choppy day. The big gap higher out of the open settled back in. So we're left about where we started this long weekend. We'll get to the rest of the charts here in a minute. I did want to update on the schedule coming up through the remainder of this week. Tomorrow on Wednesday the 2nd, we have Dave Landry from davelandry.com joining us on the show. On Thursday the 3rd, we have Craig Johnson from Piper Sandler. Then coming up next week, we have some really good guests. Jesse Felder from the Felder Report coming to us on Tuesday the 8th. On Wednesday the 9th, we have Javed Mirza from Canaccord Genuity up in Toronto. And then on Thursday, Sam Burns from Mill Street Research in Boston. So what's cool is we're going to get to talk to some of the top strategists that a lot of money managers get to talk to often. We're going to get them on our show and have some good discussion about market dynamics. Should be a lot of fun. Let's continue on with our market recap. So as I'm looking at the markets today, and again, today's show, we're going to hit it from three directions. We'll start now with the macro perspective. The S&P was really choppy. Looking at the 2-day chart here, there's a big gap out of the open. So at the open sort of felt like this could be just a big push higher to new all-time highs, but we really settled back in. And by the end of the day, we were spent most of the day below where we spent on Friday before the long holiday weekend. And so really it was chopping around. We spent most of the day sort of revolving around that closing level from Friday, closed just above 4,200. So a rounding error below zero for the day. The Dow just a tiny bit up, the NASDAQ just a tiny bit down, but it was really a flat day when all was said and done. Now, where it was not a flat return day was in mid caps up 0.6%, small caps up 1.6%. So if you look at the sector leadership, you see things like energy, real estate, materials, financials, the cyclical sectors. And when that happens, you're going to see small caps outperform because that index is more broadly exposed to those sectors as opposed to large caps, where it's more in technology and communications names and consumer names. And again, it's all just the relative weightings of some of those different indexes, different parts of the market. So small caps leading the way higher. So if you think of small versus large as sort of a general risk on or risk off signal, you definitely did not get any sort of risk off signal from today. You saw strength in small caps as that part of the market was doing just fine. The VIX, by the way, up a little bit today, just above 18 again. Looking at some other asset classes very quickly, 10-year yield settled in around 161, 162, and the TLT was essentially flat. Not a lot going on there with the dollar as well, which was about 0.1, 0.2% below Friday. Gold and precious metals down a little bit today, but not by much. The real strength, though, looking at all of these charts, the strongest moves I see are in the commodity space. So besides precious metals and also copper industrial metals, when you look elsewhere, energy and hard and soft commodities, you see a lot of strength. And the DBC making new highs again today. We're going to look at that chart here in a few moments. to make sense of it. Cryptocurrencies, by the way, fairly negative across the board, with Bitcoin just above 36,000. Spent much of the day here sort of chopping around that level. This was after a big run higher going into in today's trading on yesterday. Saw a big rally into early hours here on June 1st, but overall distributing through the course of the day. So, it's interesting how cryptocurrencies have become, I think for me, sort of a measure, not just of risk on versus risk off, but more speculation on versus speculation off, if that's a term I can coin here today. Because it's not just about whether you want to take on risk. That's taking on a next level risk, right? You're taking on huge volatility for the opportunity for huge returns. So it's really a pure play on speculation. The fact that that continues to unwind, I would say overall, is speaking to a lightening of the speculation across the board here. And that might be one of the ways we can use Bitcoin and other cryptocurrency prices here going forward to see when retail investors especially are ready to step back in and take more aggressive bets, leverage bets to the upside. We're going to talk a little bit more about sectors and individual stocks here in a moment, but just to wrap up the recap for today: energy, the big gainer today, followed by real estate, materials, financials. On the downside, healthcare at the bottom of the list, followed by utilities, and then technology. So this was not a return to the growth trade. This is much more on the value side of the ledger. Let's look at a daily chart of the S&P here. So we talked about this on Friday's show when we went through the Mindful Investor Live chart list. But just to review, if you take a trend line from the October low, connect it to the March low, that connects beautifully with the May and the early May and the mid-May low. And that right now is sitting around 4120, a trend line using those lows and also the 50-day moving average right about at the same time. So if and when we would pull back from current levels just below or just around 4,200, that would be the first logical step. And what's interesting, that actually lines up with the low from mid-April, sort of that last swing low before we made new all-time highs, teasing 4,250. So in any sort of pullback, that's about the level I would be looking at. Below there now, you have a pretty good level around 4,050, and that's the lows from mid-May. So it's interesting how this trend line, when I was learning trend lines, and again through first reading John Murphy and then reading the Edwards and McGee, which is really the Bible of chart patterns and trend lines. And that's really the book to read to get a sense of best practices for analyzing stock charts using trend lines and thinking about pattern breakouts and breakdowns. I was taught once is chance, twice is coincidence, three times as a pattern. And the idea is to have a line, if it hits a certain point, that's just a coincidence. There's nothing really you can draw from that. But once you have a second point, you can draw a line. The third time that you hit that line and bounce off of, that's when you've confirmed that trend line is a valid representation of the trends. Then when we did it again, there in mid-May, every time you test that line and bounce off of it, it sort of makes it more and more of a valid measure of the trend. And what that tells me is as long as we remain above that trend line, this uptrend that we've been in for the last 6 months remains stable. It remains in play. And that gives room for things like 4 to 5 to 6% pullbacks because you still remain above that trend line support. If and when that trend line breaks, now that it's so clear, and I think plenty of people are watching it, I would be concerned if we would break down through there. And again, for now, I think the downside risk would be to 40.50. That's sort of the real line in the sand for stocks. If and when we would break below that here in the near future, that's when I would start to be a little more skeptical about likelihood to move higher. The real story, though, when you think about strength today, as I mentioned in the recap at the beginning, is the commodity space. And we'll finish here at the DBC. If you look, real strength on this chart, and again, take a step back and just look at this trend of higher highs and higher lows. Look at these very orderly pullbacks down to the 50-day moving average back here in March, and then again going higher. So if we would pull back from here, you have a very clear support level. So this sort of analysis, investing is never easy, but charts like this make it seem probably easier than it should be, because you have a clear line in the sand. You have a level at which the market has clearly bottomed, the market has now rallied, and if and when we would come back, you have a level at which I think a lot of people will be watching. And you assume that holds. When it does, that suggests that you can buy for the next leg higher. If it fails, though, that's when you have to start to question the long-term uptrend. But at this point, making new highs, pretty impressive. The GCC, by the way, which is an equal weighted ETF, or less skewed towards energy than the DBC. Also, not quite making a new high, but very, very close. Those two charts would certainly be ones to watch here. Our next segment is called Sector Setups. This is where we focus on the trend in the 11 S&P sectors. We'll start with the RRG. This is the relative rotation graph. So we have the S&P 500 in the middle here at the crosshairs, and then we have the 11 sectors rotating in a clockwise motion around the benchmark here in the middle. This is one of my favorite ways to visualize the 11 sectors and how they rotate. If you're unfamiliar with this, look up Julius de Kempener's show Sector Spotlight. He does a great job. He created this visualization and does a great job of explaining how to incorporate it into your process. I find it a great way to just understand how the sectors are performing relative to one another. It is essentially a zero-sum game because you have the S&P in the middle, you have all these sectors rotating around. If it feels like they're not evenly distributed, you have to remember these are not even market caps. So some of these represent much larger part of the markets than others, like materials is a pretty small sector, real estate is smaller, but overall it's going to net out to a zero sum. So what trends can we take away from the short-term RG? This is actually using the daily data here. Well, what you can see are these cyclical sectors that are leading today have actually been in a period of relative decline. And what I mean is they're heading southwest, what I call the direction of deterioration. In general, when things are improving, they're heading northeast. When things are deteriorating, when things are starting to underperform and the momentum is starting to weaken, that's when they head southwest. And so these sectors in the weakening quadrant here all represent sectors that have been outperforming, but the momentum is really starting to come out of that trade. You see energy, materials, financials, the three clear ones in the lower right corner, they're all in the weakening quadrant. What has been improving, what has been starting to get better and better, technology and consumer discretionary. Those are the two in the improving quadrant. Again, starting to head northeast, which is very encouraging. The strongest ones, though, only two sectors left in the leading quadrant, and it's real estate and communication services. And we've talked about the chart of real estate. It was actually one of our 3 and 3 charts on Friday, I believe. And what that shows you is just the strength, making new highs again in the last week. And real estate is a sector I find with REITs, people just don't tend to be as familiar with the tickers, familiar with the stocks, and as a result, you stick with what you know, and you stick to things like technology and consumer and mega cap names that you're familiar with. But if you do that, you're missing out on some real opportunity for alpha, for outperformance, because a lot of times the performance can come from different sectors that you're more or less familiar with. So real estate doing well on a relative basis should be enough, I hope, to draw you to that sector. I would look for stocks in there that have strong profiles, and you'll find that it's not hard to find them when you dig into real estate. Run the scanning engine, start looking for stocks that score pretty well on the Scooter rankings or something like that. What would be very interesting looking at the RRG, by the way, is one of the most profitable ways I've used this visualization over time is when sectors do a clockwise rotation, but it's all to the right of the y-axis. Because in a normal environment, things kind of rotate all the way around the rotation. And that means there's a period when they're outperforming, periods when they're underperforming, and then it's sort of that cyclical nature of market rotation. But if you see things that have a rotation far to the right side of the y-axis, what that means is it's still outperforming the benchmark during that entire period. It's just a momentum that's either getting stronger or weaker. So I'd be very keen, given the strength in things like energy, materials, industrials on days like this. You can see the XLI just starting to rotate more sort of northwest. If you see these sectors actually rotate up and head back in a north-northeast direction, I think that would be a raging bullish indication, indicating that flows are going back into some of those cyclical leadership sectors, and you may see strength here in the coming weeks and months. Next, let's go to the S&P sectors on the candle glance function. So when you have any chart list, you can click where it says view list as, you can bring up the candle glance. This, I always think of it as taking a bunch of charts printed out and throwing them on a table and just seeing what patterns look like what. Is something when I was on the institutional buy side, we used to do that a lot as a way to just try to put things and group them into good charts and bad charts, and then just get more and more detailed from there. But at the very beginning, are these charts working or are they not? And let's focus on what's working and what isn't. If you look at the candle glance, though, you can see some interesting ideas just by looking across all the sectors. My first thing that comes to mind is which sectors are going below their 50-day moving average, and a couple come to mind. One is utilities, which I'm not terribly surprised in, only because on a relative basis, it's been pretty weak. There have been a couple times here in the last year or two when utilities have been underperforming and then start to turn higher. And in every one of those cases now, the sector just manages to disappoint all over again. So here in mid-April, I remember talking about utilities starting to work and breaking above this trend line. And I'm thinking, wow, this is really a return to the strength of utilities. Though from mid-April till now they've been underperforming, right? It's the sector has just not been able to follow through on the upside. It shows you that the leadership is not really rotating into deep defense like utilities. It's more what part of leadership, growth versus value, are things rotating in at a big picture, or at the very least, we're not going into the relative defense of utilities. Two other sectors, though, are right around their 50-day moving average, and I think these are really important to watch. Actually, it might be four of them. First off is technology. Now, tech had actually been below its 50-day, had just broken above it into last week, which I know had led a number of people thinking, all right, is this the return of technology, exerting leadership and rotating higher? It's right back down to its 50-day moving average, pulling back today down about 0.5%, which isn't horrible, but relative to the rest of the market, it's certainly underperformed. And again, I tend to take a step back on charts like this, and I'm seeing the red arrow indicating this decline, this relative decline, or this decline in relative performance. Since mid-February, this has been a sector that has forced you to underperform by owning it. I'd much rather be in things that are outperforming, of course, in any given moment. So technology is interesting. We want to see if it can hold the 50-day moving average. Discretionary, consumer discretionary, broke below its 50-day, now testing it from below. Can it get back above there, indicating some overall leadership, or does it fail there once again at the 50-day? Final one I'll point out is healthcare. Now, healthcare is not bad yet. It's still not far off of all-time highs about a week and a half ago when the XLV got above 125. But now we're right back at the lower end of this price range, testing the 50-day moving average. My question there, as the relative strength declines, can the XLV hold support? We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we review the top charts of the day together. My goal with this sort of show is that you can learn from some of the ways that I'm describing these charts, analyzing these charts, and I hope that it can help enhance your own decision-making process. And as you go through that process, we are here to help you along the way. You can email us with any questions that come up as you are analyzing your own charts, and we'll hope to answer one of your questions in our next mailbag segment. Our email is thefinalbar@stockcharts.com. You can also just tag us on a Twitter comment at FinalBarSCTV. Finally, on YouTube, just put a comment below the video that you're watching. We would love to answer one of your questions in our next mailbag segment later in this week. Also, as a reminder, go to StockChartsTV.com. Use your email, set up a free account, and you can immediately begin watching all of our fantastic content. We have a great group of hosts, some wonderful guests that we bring on every day and every week on the channel. All of that is available on demand from our website. Also, all of the app stores, just search for StockCharts TV on demand. Our next segment today is called Shifting Stocks. So we've now gone through the big picture, talked about stocks overall in a position of strength, small cap leadership today. Commodities really the story, though, driving energy prices higher. Talking about the sector rotation there in the just before the break, we talked about the strength in some of those cyclical sectors, but also some key sectors testing their 50-day moving averages with healthcare, with utilities, with consumer discretionary, with technology. Are they able to hold those 50-day moving averages? If they broke below them, like consumer discretionary, can they push back above them and indicate some buying power coming in? Otherwise, it's certainly more of a sign of distribution coming off a period when all 11 S&P sectors were above their 50-day, starting to not so much be the case anymore. Our final segment now is Shifting Stocks, is where we look at some individual stocks. Part of my routine every week is to go through all 500 S&P charts, do a series of screens looking for new swing highs and new swing lows. And so this is basically me hitting on some of the charts that are top of mind after going through that. I wrote a note to my premium members earlier today talking about a Barron's article, which is 10 stocks to benefit from all the congestion we have in the supply chain right now. It's sort of a shortage of everything, and which stocks can help us get back in there. And one of my comments was that, the good thing about ETFs is you have very specific exposure that you can get with different ETFs. Now, with any ETF like PAVE or any others, I'd always remind you it's best to do your due diligence. Think of things like the buy sell spread, look at things like expense ratios, management fees, all of that with any sort of investment product. Make sure you do your due diligence on them. We are really, for this show, focusing on price behavior and the indications of that. When I'm looking at the chart of PAVE, which is a pretty decent ETF giving exposure to infrastructure and investment in infrastructure, which certainly does not seem to be declining anytime soon. Overall, I'm seeing a chart that I would probably be very happy to own if I had if I had a portfolio of stocks or ETFs that had just appreciated, generally speaking, fairly consistently from the March 2020 market low. So for the last year plus, just in a nice consistent uptrend, bouncing off its 50-day consistently, but then rotating higher. Relative strength that's just been essentially net positive the entire time. It's hard to find a lot to not like about that chart. And so when I'm looking at some of the stocks that were mentioned in the article, this was the chart that came to mind. Looking at those individual stocks, this is a pretty decent bet on the nature of that article. Improved investment in infrastructure, and I think from a technical perspective, decent chart that continues to just rotate higher on pullbacks. Let's look at some charts that are less maybe ideal, and we'll start with one, Apple. We've talked about this chart a number of times recently, and I just think it's worth highlighting today because this is the pattern that we've been talking about, which is a coil pattern, or what's called a symmetrical triangle pattern. Now, if you look back here, August, September, October of last year, you had the big run into the market peak in early September. You had this bearish engulfing pattern, and then Apple, along with many stocks, settled into a sort of consolidation phase. Lower highs, higher lows, revolving around this midpoint around 116 on Apple looking back. And you can see the breakout out of that pattern to the upside was one of the indications, I think, that was sort of an all clear for the markets. It showed you that Apple was appreciating, showed that buyers were coming in and were willing to push the stock out of that pattern to the upside. Very encouraging. What I'm concerned about right now on the chart of Apple is we're starting to get, I think, basically the opposite signal. Once again, you had a nice run into the high in late January. You have a pattern of lower highs and higher lows revolving around a midpoint, this time around 128 to 130 or so. Now, however, you've broken down out of that pattern to the downside. We've now closed below that pattern last 2 days. On Friday, we actually closed below it. We followed to a lower close today. We're now sitting at the 200-day moving average. Apple's been above its 200-day moving average for a year plus, going back quite a while. And so, is it able to hold the 200-day right now, which is where it's bounced off of a number of times? So I think you are very close with this chart from transitioning from a consolidation phase, a sideways pattern of lower highs and higher lows, to a breakdown, breaking out of that pattern to the downside, breaking below the 200-day moving average for the first time in a year and a half. None of that is positive. I see that overall as kind of a net negative. And also the fact that it traded up to its 50-day and now has failed a couple times. Overall, again, the stock is still holding up okay, but I would just describe it as okay at best. I think we're very close to more of a negative signal, and I'm seeing a lot of charts that are much more in much better places than that. GBTC is one, and while not a stock, it's obviously an ETF, and it's not actually an ETF, it's a trust. So do your due diligence on that one. It has not done a great job of tracking the price of Bitcoin. Bitcoin was up, I don't even remember the percentages, but GBTC was essentially flat when Bitcoin was up 40% at one point earlier this year. So it's had some trouble because of the way that it trades at a discount to the value of the assets underneath it. But the reason why I wanted to highlight it today is because the GBTC is back below its 200-day moving average on a closing basis for the first time in about a year. The last time it was this low was back in June, July of 2020. So this is quite a rotation down from something that went from single digits up to, touching almost $60 a share just a couple months ago. And now we've given all of that back. It's 50% below those highs and now back below its 200-day moving average. The real tell, I think, was establishing some lower highs here in March and April, and then breaking below the support level, breaking below the lows of that basing pattern. So, now we're testing support back at the January low, but overall, this is a chart that I feel like the path of least resistance is lower until proven otherwise. That's a concern. If you want to get more optimistic, bring up some material stocks. I was looking earlier at our scooter rankings. When you look at the top 10 stocks in the scooter rankings, let's look at them very quickly here on the left. When I counted earlier today, we had 6 out of the 10 that were in 2 sectors, energy or materials. You have in energy, Marathon Oil, DVN, FANG, What else? Hassall within the energy sector. Within materials, you have NUE, a steel stock, and then you also have FCX, Freeport-McMoRan. And when you look at the chart of FCX, again, it reminds me of the chart of PAVE, just a really strong long-term uptrend. These are the types of charts that have demonstrated their ability to provide viable dips along the way, but overall just continues to make new highs. It's now rotating off of a pullback down to the 40 level. If we would sell off a little bit, I'd be looking for support around the $40 level, and then below there at the 50-day moving average, which has held a number of times, but overall not overbought, rotating back to the upside, up about 3.5% today, and I still see a lot of potential upside there. We need to finish off just looking at a couple earnings names. We'll start with Zoom, which actually just reported after the close today. And as a reminder, if you go to our symbol summary page, this can show you after hours trading. We're working on incorporating that after hours data into all other parts of our platform. But at this point, if you go to the symbol summary, it'll tell you when something's reporting today or tomorrow. And you can see the during the day close, which was down 1.1%. It's down another 1.2% in the after hours around 323, 324. So that might be an interesting chart to watch through the course of the week. Overall, Zoom has been in a decline. The relative strength has been underwhelming really since the fourth quarter of last year. I'm seeing a chart that's in a pattern of lower highs and lower lows. There was a chance it was getting better as it retested those previous swing highs and got above the 50-day. We're pulling off a little bit, and if we open tomorrow where we're at in the after hours, that'll put it back below the 50-day moving average. So certainly some distribution there, and that's in one of the lowest, bottom decile of scooter ranked stocks out there. A number of other stocks reporting this week: DocuSign, Lululemon, Smuckers, Advanced Auto Parts. We don't have time to look at those, but certainly focus on the charts going into that earnings release. We need to wrap today's show and go to the three charts in 3 minutes. Here we go. Chart number one is the DBC Commodity Index. There are a number of different commodity ETFs and indexes you can track. The CRB index is a common one. The DBC is the one I tend to use more than anything. Another good one to look at is the GCC, which is more of an equal weighted ETF. So the problem or the challenge with DBC and the CRB index is that they're really overweighted to energy, particularly crude oil. And so when these charts go up, it could just be crude oil doing very well, and it's making it feel like all commodities are up. So the GCC can be a better gauge of overall commodity performance. But I think it's worth noting the DBC is one that I know a lot of people use for exposure for themselves and for clients to commodities. Worth noting, making a new long-term high today, new 52-week high on a closing basis and on an intraday basis. This is after a recent pullback. If you would pull back from here, $18 is a really clear support level on the chart, and the 50-day moving average not too far below that. But overall, I see a lot to like continuing to be in the commodity space. Chart number two is looking at the spread between the 10-year yield and the 2-year yield. This is a common way to look at the shape of the yield curve. If this line is going higher, that means the spread between yields on a 10-year treasury bond versus the 2-year treasury note are widening. If this line is going down, that means the spread is narrowing, meaning the yield curve is flattening. We have a great animated yield curve on StockCharts where you can actually see over time what the shape of the yield curve does. What I'm showing here is the rally in that spread, the improvement in that spread until late March. From there, the spread has essentially been sideways. It's been sideways. Now, in general, financial stocks tend to do well when this spread is going higher. If you look over time at the relative performance of financials, which is the bottom series here in navy blue, overall, this spread going higher is good for the financial sector because that's essentially how banks make money, is on that spread from the longer end of the yield curve to the shorter end of the yield curve. Even given this flattening or really the stabilization of the spread between the two, the yield curve remaining stable, financial stocks have managed to make a new relative high in the last couple of weeks. I'll be very interested to see if this rotates to the upside and if we continue to see performance from the financial sector. Finally, we'll leave it with the PAVE, the infrastructure ETF. There are a number of different ETFs that provide exposure to some of these industrials, materials, and other stocks that should do well given improved or increased investment in infrastructure. We talked about this a lot in election season last year, thinking about the fact that both candidates were talking about the performance of infrastructure. The chart is demonstrating that case. Folks, that's our show for today. Thank you so much for watching our show every weekday after the close. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.